Hello everyone, welcome to Concepture Academy. Today's lecture is all about the balance sheet, one of the three main financial statements used to understand a company's financial position. So let's begin by asking, what do we mean when we say financial position? In simple words, it's like taking a snapshot of a business at one point in time and showing what it owns, what it owes, and what's left for the owner. So now let's see how this works in real life. The main thing about a balance sheet is that it is a financial snapshot of a business at a specific point in a time. And in other words, it's a statement that shows the financial position of a business and answers the simple question like what does the business own and how did it pay for the assets. Let me explain a balance sheet in a very easy way. Imagine you want to check how much you have and how much you owe right now. You take a paper and start writing. On one side, all the things you own, like your cash, your mobile, your laptop. While on the other side, what you owe, maybe a loan you took from your friend or a bill you need to pay. So now whatever is left after paying off what you owe, that is your own worth. So this simple idea is exactly what a business does when it makes a balance sheet. Now that we get the basic idea, let's look at the rule that makes the balance sheet always stay balanced. This is the most important formula in accounting and the heart of the balance sheet. A rule that always applies in accounting: assets are always equal to liabilities plus equity. Everything the business owns comes from two sources, either the business borrowed the money or the owner invested it. That's why both sides are always equal. Let's understand this with a simple example. Suppose you start a small bakery and you invest $200,000 of your own money. Then you take a bank loan of $100,000. So now you use that money to buy equipment and ingredients worth $300,000. So here is the math. Total assets are of $300,000, liabilities are of $100,000, and equity is of $200,000. $300,000 are equal to 100,000 plus 200,000. So the equation is balanced. The balance sheet will always follow this rule even if a business is big or small. The total assets will always be equal to liabilities plus equity. That's why it is called a balance sheet. It must stay balanced. Now that we understand the rule, let's explore each part in detail. There are only three parts of a balance sheet. Imagine your own business. Assets are the things a business owns. For example, cash, furniture, machinery, stocks or inventory, buildings. So these are all valuable items that belong to the business. Then assets are further categorized into two types: current assets and non-current assets. Current assets are used up soon, like within a year. These include cash, stock, bank money, and receivables. Non-current assets are kept for more than a year, for example, land, buildings, furniture, and machinery. These non-current assets are further categorized into fixed assets, intangible assets, and long-term investments. Fixed assets like land and building, intangible assets like patent and trademarks, while there are some long-term investments in which business is engaged. If the business can use it, sell it, or make money from it, it is an asset. So remember this thing. While liabilities are a bit different, the things a business owes to other, for example, loans from the bank, bills to suppliers, and salaries payable. If the business has borrowed money or hasn't paid for something yet, that is a liability. Liabilities are also categorized into two types: current liabilities and long-term liabilities. Current liabilities are paid within a year, for example, bills, wages, short-term loans, while long-term liabilities are paid after a year, for example, big bank loans or bonds. These current liabilities are actually the debts or obligations that the business must pay within a year, and it includes account payable, short-term loans, salaries payable, and taxes payable. While current liabilities are like your monthly bills, the long-term liabilities are the long-term loans. You are taking a loan For example, a car loan, you don't pay it all at once, but in parts over many years. So it would be your long-term liability. Now here is a format of balance sheet for your better understanding. So first of all, we write the name of the company, and then we write the name of type of financial statement as it is balance sheet, and then the date is mentioned. And here the date is 31st December 2024. Then on the assets side, first of all the current assets are mentioned, then non-current assets are mentioned. Then the total of current and non-current assets are written. Here it is $500,000. On the other side, liabilities and equity is written. First of all, current liabilities are mentioned, then non-current liabilities are written, and after that, equity section is there. So total liabilities and equity are $500,000. So you have noticed here a very important thing, that liabilities are written before the equity, and there is a logic in that, because in case of liquidation of the business, claims of the creditor has got priority over the claims of the owner. They get whatever is left after paying the creditors. Let's quickly go over what we have learned today. The balance sheet gives a snapshot of the business financial health on a certain date. It shows what the business owns, what it owes, and what is left for the owner. So now let's do a quick concept check. No writing is required. Just try to answer these questions. If you bought a laptop for your business, is that an asset, liability, or equity? Yes, you are very right. That's an asset. You took a 2-year loan. Where does it go? It's a non-current liability. Very well done. And if your assets are greater than your liabilities, what does that tell you? It means your business has positive equity and it is in a healthy position. Great job everyone. That's all about today's lecture. In the next class, we will learn about the income statement, how a business earns profits or make a loss. So don't forget to like, share and subscribe to Concepture Academy, and stay connected with more easy lessons on accounting and finance.